Is inflation all in your head? Or do we finally man up and blame the Google searches? Today, the Wall Street Journal covered an unintentionally hilarious paper by former Fed Chair Ben Bernanke and former IMF Economist Olivier Blanchard that tries to blame inflation on everything they can think of but the money printers. The journal notes correctly that Bernanke and Blanchard are among the, quote, world's most cited academic economists. In academia, most cited means most respected. So the hilarity says a lot about modern academic economics. On to the paper. From the journal's description in the paper's model, quote, inflation is a function of, among other things, the gap between the supply and demand for labor, the public's expectations of inflation, commodity prices, and supply chain disruptions derived from Google searches for shortage. In other words, they threw in the kitchen sink on that baby, yes, even the Google searches, to desperately avoid telling the truth that money printing, including by the organizations that pay both their salaries, is what caused the inflation. By the way, not to get too far into the weeds, but that inflation expectations is a particularly cute statistics game they play to push money printing out of the equation. That one I will do a standalone video on, but suffice to say you can chase anything out of an equation that you want. As the saying goes, quote, torture the data long enough and it will tell you anything. Now, this is not just Bernanke and Blanchard covering, but this is par in monetary economics, the part of economics that deals with inflation. In the US, roughly 90% of monetary economists are literally paid by the Federal Reserve or its proxies, either directly in salary or in the form of academic grants that are a very polite way to say bribe. This means, to a first approximation, any academic economist is simping for the Fed, reciting the party line. I, for the record, have never been paid by a central bank. I would be both shocked and amused if they offered. So back to the paper. Their conclusion after 47 pages with appendix of suitably tortured statistics is that runaway inflation was a, quote, complicated phenomenon involving, quote, excess savings, reopening of economies, and strong aggregate demand with only a bit role for government. To which the solution, in the journal's phrasing, is, quote, the economy has to cool off, which means a weaker labor market. In other words, it's all very complicated, but Americans spent too much, they expected too much, and the solution is to crush them, crush millions of jobs and tens of thousands of businesses. So what would an economist who is not paid by the Fed and the IMF say? Simple. They printed an ungodly amount of money to bribe voters into lockdowns, $6 trillion in 3 years, to the point nearly $1 in $3 still had fresh ink. Then, when all that money flooded into inflation, instead of cutting government spending, they decided to beat it out of the people, out of workers and small businesses. Now, at this point, we have a golden opportunity with the debt ceiling to correct that mistake so that, for once, they cut government spending down to size instead of cutting the people down to size. Of course, most likely they will not take it. Okay, we'll be watching. See you next time.